after what we heard from Jay Powell saying that the ultimate level of rates could be higher than previously expected, has that changed how you manage your portfolio?
So first, I don't think he had a choice. The break-even inflation's just on the 2-year came from 5 down to 2%, but they went up to 3 in October. No choice there. But I think the key is to look for companies that are growing their margins. If you look at the S&P 500 in Q3 earnings season, the rally in October had a foundation of not disastrous results, just about a 3% bottom line increase year over year, but that was 11% top line, margins shrinking. To give you a counterpoint to that, the S&P 500 dividend aristocrats, they're companies that grow their dividends for 25 straight years, at least as a minimum, actually grew their top line 17%, but 26% bottom line. If you can figure out a way to expand margins, even in the face of inflation, that's a safe haven these days.
Yeah, I think that's the key anytime, actually, expanding those margins. Something I want to ask you about when you look at portfolio management. Right now, we're seeing the 2-year at a high we haven't seen since July of 2007. When you're getting that kind of return on a bond, especially a short bond, does that change the way that you balance?
If you look at the yield curve right now, everybody's talking about the inversion. But I think the inversion is less about a real bearish long-term view than still a view that the Fed won't stay high that long. Back to those break-even inflation numbers, at 3%, if 3% inflation actually persisted for a long time, you could see the 10-year somewhere around 5. But the 4 and change that we see right now is more of a reflection of the Fed not hanging out at, say, a 5% Fed funds for really that long.
Wow, the 10-year at a 5% yield? What would that do just in general if we see rates get that high on the 10-year?
Well, 5's not that high historically.
Not historically, but we're used to really low rates.
But I think we have to get used to a new normal. So the long-term average for the 10-year bond is 2-year real and 2-year inflation. 2-year inflation is the Fed target, 2% real. That's what you get when you don't have quantitative easing. We have quantitative tightening. So to get up to 5, I don't think is that bearish a sign, again, as long as we have a relatively shallow recession.
Simon, you've been one of the people that are really on the soapbox about corporate credit and paying attention to it. A lot of people looking at the return you can get on corporate credit as opposed to the volatility of the equities themselves. Are you focusing more on that corporate credit?
Well, I think there's a misconception in the market today. You hear a lot of people who suppose and assume that there's a lot of leverage in the system. But that's actually not the case. If you look at the S&P 500, net debt to EBITDA, the most common measure of leverage, is at all-time lows, less than 1. That's very low leverage. And if we look at what happened in the month of October, yes, high-yield spreads came in, but investment-grade spreads didn't move much very far at all. So you actually have some decent spread there. You have low leverage. I think that's a real opportunity for corporate credit.
All right, of course, we got to continue to look ahead to this jobs report. Before we let you go, what's the most important metric? Job growth, as we mentioned, is going to be high. Wage growth is going to be a factor. Unemployment, kind of give me a sense, because everybody's kind of with bated breath thinking that a good report might be bad for the pause of the pivot.
It's got to be the wage growth number, because it's inflation we're worried about. We know that the job market's still snug, but we've had 5% wage growth. That's the sticky thing that stops inflation from coming down. That's the spiral that we saw in the 70s. Look, we don't have unions to the extent that we had. They shouldn't be as sticky, but that's the number we have to look for.
Yeah, also shelter inflation, something else to watch just in general as we go past this jobs report. Really quick prediction for what we're going to see ahead. We have a sense of what the estimates are from the jobs report. How do you see the market reacting?
I think it'll be a modest up day. I think we're going to get a little bit of a tick down in that wage growth number, and that's going to give people a little bit of comfort.